In this video, I'm going to share with you all of the business knowledge I've obtained over the past 5 years that's cost me about $100,000. Now, a lot of you may see me as just a programmer or a YouTuber or some kind of simplistic title, but the reality is I've been running companies for the past 3 years. I am a part owner or a complete owner of multiple corporations. I have all kinds of funds moving all over the place all the time, and I am very, very concerned about reducing and deferring taxes, and with that comes some complex structures. So in this video, I'm going to share with you a ton of nuance and a lot of detail about what it's like to actually run multiple companies, how you control a relatively high income and make sure you don't pay a massive amount in taxes, how you access corporate funds personally, how you do all kinds of stuff that I never see people talk about, and that is very, very important that I've had to pay a lot of money to learn over the past few years. This money has been paid to accountants, lawyers, bookkeepers, investment professionals, advisors, and all of the other people that you can imagine. So with that said, sit back, relax, and let me share with you everything that I know for free. So let me start this video by sharing with you a piece of mindset that's important for a successful entrepreneur, and that's related to opportunity. Specifically taking advantage of opportunity and kind of searching out in the marketplace for it. Now, to give you a prime example, I'm going to take the opportunity to share with you that I just released a brand new course called Blockchain Expert. If you're interested in Web3, blockchain technology, you want to learn more about how this works and potentially become a blockchain engineer or Web3 developer, check it out from the link in the description and use discount code TIM. Now, in all seriousness, guys, what I'm going to share with you in this video is really everything you need to know about kind of more complex corporate structures. So having multiple corporations like a holding company, how you can use a trust to kind of prepare for a liquidation event or a sale of a company, how you can invest funds within a company, how you can control your income, defer your taxes, and access funds from your corporation when you need them personally. This is going to go a lot further than, set up a corporation because it reduces liability, or, you don't want to be a sole proprietor. I'm going to give you all of the nuanced details that often aren't shared in videos like this. So with that said, let's dive in. All right, so let me begin by outlining the kind of main goals that you should have as an entrepreneur when it comes to business and when it comes to these different structures that I'm going to talk about. Now, goal number one, I hope for most of you as an entrepreneur, is to make as much money as possible, right? I absolutely want to do that. Anyone who tells you they don't want to do that is probably lying, and that's why I have this YouTube channel. I sell products. I'm a part owner in another company that's a startup right now, etc. I want to make as much money as possible. That's goal number one. Goal number two is to keep as much money as possible. It doesn't matter how much money you make if you keep none of it, and this highly involves paying the least amount of money in tax as possible or deferring your taxes until a very far kind of point in the future. Ideally, you want to keep as much money as you possibly can. That could mean saving money. That also typically means saving money on taxes, which is really one of the main purposes of all these kinds of structures. Now, goal number three is to reduce your liability. Specifically, personally, also in a corporation, you want to make sure that if you were ever to be sued, if something kind of traumatic were to happen, that you would not lose a massive amount of money. You want to protect your assets and protect your funds. Goal number four would be to have flexibility, right? Be able to take out money when you need it, spend money when you want to, go and buy an expensive car, go buy a house, kind of do what you need to or do what you want to, and have the flexibility to access your funds from multiple places. So those are the four goals, at least, that I have. I hope that you guys have those goals as well. Keep those in mind, sorry, as we go to the future sections in this video. So in this next section, I quickly want to talk about the different legal entities you want to be concerned with and the information, at least the basics you want to know about it. So when we're talking about legal entities, we have our sole proprietorship, we have our corporation, we have partnerships, we have not-for-profits, we have other more complex structures that I don't need to discuss. For 99% of you here, you're going to be concerned about sole proprietorship and corporation. Now, when I say corporation, that could be an LLC if you were in the US. I'm in Canada, but most of what I'm going to say here applies to the US and North America in general. Okay, so sole proprietorship, corporation. I know many of you know this stuff, but when you're a sole proprietor, that means you don't have kind of a formal legal entity. You're operating kind of under your own name. Maybe you have a business name. I don't know exactly how that works, but the idea is that all of your kind of personal stuff and business stuff are kind of mixed together in a sense. If you were to ever get sued as a sole proprietor, you would be personally liable. Let's say you got sued for $1 million and you had a house, well, you would have to sell that house to pay that $1 million. Okay, so the liability is atrocious when you're a sole proprietor, and the taxes are very poor as well because you're not able to control your income, and you get kind of double taxed on payroll taxes, which we can talk about in a future section. Anyways, sole proprietor, not ideal. However, it does make sense if you're making a very small amount of money and you don't want to pay the fees associated with a corporation. If you're not concerned with liability, no issue being a sole proprietor, but if you start making more than 50, 60, 70 grand a year, you probably want to consider transitioning into some type of corporate structure. Okay, next, corporation. Corporation has limited liability. It's not completely unlimited. It means that you could potentially be personally liable, but it's a lot less likely depending on how you set things up. In a corporation, you have much more control over your income and taxes. Typically, you're going to pay much less in taxes and be able to retain more money within your corporation. There's various other benefits as well, but those are the main ones you need to be aware of. So for most of you, you have to think to yourself right now, does it make sense for me to be a corporation? Really, this answer is going to require some legal advice, talking to an accountant or lawyer, but I wouldn't even bother paying the consultation fee unless you're going to be making, again, 60, 70, 80 grand per year or more, or you think you're going to be at that point relatively soon in the future. All right, so moving on here, let's say that you've decided you're going to be a corporation, or you already are a corporation. You have a company or some kind of corporate entity. Now what you need to consider is what it takes to operate a corporation. So I'm going to share with you kind of what my operation of the corporation looks like, relative fees and costs associated with that. And keep in mind that at this point in time, my corporation is not, I wouldn't say it's complex. It's just me. I'm the only kind of director and owner of the corporation, but I have a significant amount of transactions and a very high level of income in the corporation. So it's not, a corp that's making 100 grand a year. It's making multiple hundreds of thousands of dollars per year, has investments, has some more complexity. So mine is going to be a bit more expensive than someone just starting out would be. Okay, so operating corporation, what do you need? Well, first of all, you need your minute books to be taken care of. Now, the minute books essentially keep track of any share operations, ownership operations, stuff related to directors. I don't even really know exactly what happens in the minute books. I let my lawyer take care of that. But every year, your lawyer kind of needs to update the minute books. That's going to be a few $100s. So keep that in mind. And these minute books, need to be stored typically in a physical location at some law office. I actually just had mine transferred here to Nova Scotia because I just moved from Toronto to kind of Halifax now. Okay, next you're going to have your bookkeeping. Now, this bookkeeping could be done solely at the end of the year before you prepare your end of year financial statements, but typically you're going to want a bookkeeper at least quarterly to go in, update your books, make sure you have some kind of idea and picture of the financials of your company. You know all of the income, you know all of the expenses, you know your balance sheet, what assets you have, the depreciation on those, and you want an accountant to be doing this, right? Which is a bookkeeper. My bookkeeper costs about $225 per month, goes in once per month, updates everything. And this is very valuable to me because I like to see this. I like to look at my books and I like to be able to analyze all of my expenses and my income and understand, okay, where am I making money? Where am I losing money? Where can I cut expenses? Where can I increase revenue? And what activity should I be focusing on that's bringing in the most amount of money to the corporation? So you want a bookkeeper. Most of you can do this quarterly. Again, it's probably going to be about $200, $250 a month, depending on the volume of transactions that you have. Next, yearly statements. These are the most important. So as a private corporation, as many of you know, you need to file every single year. You need to submit your profit and loss. You need to submit your balance sheet. You need to submit anything related to the change in directors or ownership, etc. Right? I don't know exactly what you need to file. My accountants do all of this for me, but it's something along those lines. Okay. So you need to have professional help doing this for you, or you have to completely know what you're doing. Even myself, knowing quite a bit about this, I would not trust myself to file my own corporate returns. I pay my accountant at the end of the year. It's usually about $1,500 for them to file and prepare all of this stuff. And for most people, it's probably going to be less expensive than that. I have multiple corporations, and when you kind of combine all of them together, yeah, it's around $1,500, $2,000 for the year-end statements. Okay, next. taxes. Now, of course, you need to pay taxes. Now, a lot of times you don't know exactly how much you're going to owe in taxes, and you need to pay it before you're going to be filing your year-end statements. At least that's what happens for me in Canada. So what I typically have to do is come up with some kind of estimate for what my taxable liability is going to be, and I need to pay a little bit higher than that estimate before the taxes are due. I think that's sometime in April here in Canada, because my corporate year end is December 31st. Now, again, this is going to depend on your country, but you need to pay your taxes. So whenever you're running a corporation, make sure you know what the corporate tax rate is, and this is the rate that's going to be charged on your profits. So if you have a 100K profit at the end of the year and your corporate tax rate, depending on the state or province you live in, is say 22%, you want to be keeping at least $22,000 in the bank in cash, ready to pay your taxes. For me, I keep probably 6 figures in the bank just to make sure I always have enough for taxes at any point in time. And I typically prepay my taxes a few months in advance to make sure I don't forget. So general idea here is make sure you save for taxes and pay your taxes. Ask your accountant. You probably have to come up with some kind of trial balance or some kind of estimate for how much the taxes are going to be. And again, typically you pay that before you actually file your year end. Okay. Now, once you file your year end, any amount you've paid over in taxes, you will then be owed by the government. Typically, you will just apply that to your balance the next year, or you can actually take a refund check from the government depending on your situation. If you've underpaid, then obviously you need to pay up the balance. And then what's going to happen is the government will put you on a schedule on when you owe taxes the next year. So if you had a substantial amount of income or you owed a substantial amount in taxes, typically they're going to get you to remit taxes based on your last year income, either monthly or quarterly. So for me this year, for example, I now need to submit my taxes quarterly, and that's going to be 1/4 of the amount that I owed the previous year. And then at the end of the year, I will need to pay more, probably, if I had more income than I did in the last year. Again, ask your accountant, ask your lawyer, they'll tell you what you owe, but just remember, taxes. Keep money in the bank, make sure you have taxes, and make sure you pay them on time. All right, so next we have HST or GST, sales tax, whatever you want to refer to it as. Now, I don't know exactly how this works in the US, but in Canada, the way this works is that if you make more than $30,000 per year in a self-employment way, then you need to charge HST on every single product and service that you sell. Now here in my province, it is 15%. I know that's ridiculous. In some states, I think it's like 2%. They might not even have a sales tax. Anyways, it's absurd. But let's say I have a $100 service that I'm selling to someone. I actually have to charge them $115. I need to mark that $15 was for HST, and then I need to remit that HST to the Canadian government. Now, the only benefit here is that when you do this remittance, you also get to claim any HST that you have paid, and you get that refunded. So let's say I go out and buy something for $200. I pay $30 in HST. Now, what I get to do at the end of the year is I get to say, hey, I paid $30 in HST, give me my HST back. And the government will send it back to me. Usually what happens is you're just going to subtract how much you owe them versus how much they owe you, and then you're going to pay them the difference, or they're going to refund you the difference depending on what the amount is. That's how it works in Canada. I don't know how it works in the United States, but I'm sure there is some kind of sales tax that you need to be charging if you live in a sales tax state, and you need to make sure that you're doing that, because if you don't do that, you still owe the sales tax. So let's say that I charged someone $100 when I should have charged them $115. I owe $15 to the Canadian government because I didn't charge them HST when I was supposed to. So that's out of my pocket. It's not out of their pocket. And that just means I'm losing money at the end of the year. So any HST that you owe the government is not your money. It's the government's money. And again, you may have to remit this quarterly. You may have to remit this yearly. Depends on what the amount was the previous year and what schedule the government has you on. All right, so now we're going to move to probably the most important section in this video, which is related to accessing corporate funds personally. Now, the first thing I want to say here is that it is very, very important that you understand what you're doing when you give yourself money from your corporation. There is a variety of different ways to do this, which is what I'm going to talk about here, but it's very easy to accidentally commit fraud, especially tax fraud, if you don't understand what you're doing when you take money from your corporation and you use it personally. The first thing you need to understand here, this core concept, is that the money in your corporation is different than your money personally. What you can go and do in terms of buying a car or buying a house or spending daily expenses is much different than the corporation's funds, okay? So just because you made $100 grand in your corporation doesn't mean you can go and spend $100,000 personally. Very, very important that you understand this. It's also very important that you have separate accounts, right? You have a separate corporate bank account. You have a separate individual bank account. You have separate credit cards for your corporation and for yourself personally. Even if you have, say, a personal credit card that you use in your corporation, that's fine, but you should have that card only be used for corporate expenses. So you're separating everything out and you're not accidentally committing fraud with the personal card that's used for your corporate account. All right. Keep that in mind. Consult your accountants, consult your lawyers, make sure you know what you're doing here. So now that we've talked about that and you understand that you need to keep these things separate, we have to understand how you get money out of your corporation. So first of all, what money does your corporation have? Well, you have all of the revenues that you generated. You're going to have cash, which is typically going to be different than the revenues because you have expenses as well. And your profit at the end of the year in the corporation is your revenue minus your expenses. Okay? That's the basic idea behind it. Now, with those profits in your corporation, that is the money that remains in your corporation unless you decide to take it out via dividends, or maybe you reinvest it or whatever, you put it somewhere. But the idea is whatever you have in terms of profits is the after expense amount in your corporation that you then get charged corporate taxes on. Now, what do we do in terms of getting yourself money personally? So again, many different ways to do this. The first and most popular way to take money out of your corporation is to pay yourself a salary. Now, this is just like any other salary you would get from any kind of job, okay? You would issue in Canada, it's called a T4. I'm not sure what it's called in the US, but what happens is your corporation pays you, say, $100,000 a year. You then pay the personal income tax rate on $100,000, and that $100,000 is an expense to the corporation. The corporation remits the taxes that you owe to the government on your behalf, and it pays its half of the payroll taxes. You pay your half of the payroll taxes, and again, all of this gets recorded, and then your corporation issues you a T4. Again, that's what's called in Canada, that you submit to the government at the end of the year to declare how much money you made personally from the corporation. This money is your salary, and your after-tax amount that you take home, you can spend on whatever you want. You can go and be an idiot with it. You can go buy a house. You can do anything you want with that salary money. Okay? Step one. Now, the thing with the salary is that you pay personal tax on this salary. Now, again, that's an expense to the corporation, but typically your personal tax rate is going to be significantly higher than the tax rate in your corporation. So it's not always the most beneficial to take money out of the corporation as a salary because this is the most expensive way to take the money. You're paying personal tax rate on that salary. Okay, that's step one, most common. Most people are going to have some kind of salary and then in addition use these other ways that I'm going to talk about. That's step one, most basic. Now, maybe not step two, but method two is to use dividends. Now, dividends is cash that's left in your company after you've paid your corporate taxes that you can then issue to shareholders. Now, dividends are taxed at a different rate than personal income is, and this again is money that is left in your company, and a dividend is not an expense to the company. So if I dividend 50K or 100K out of my company, that's not an expense to the business because this is money that I've already paid tax on that now I'm giving out to shareholders. Now, there's a few rules here when it comes to issuing dividends, so please, consult your lawyer or your accountant or whoever is advising you on how to do this. But this dividend is just essentially cash that you can give yourself personally. Now, you get taxed on this personally. The tax rate is much lower because you've already paid taxes on it in the corporation, and now you're paying taxes on it again personally. Now, in Canada, we have an integrated tax system, which essentially means it doesn't matter how you got money personally, you're going to end up paying essentially the exact same rate that you would have paid if you were to pay yourself personally, okay? Now, that might confuse some of you. I'll dive into that more later, but the idea is you have your salary and you have your dividends. Understand the core difference between them. All right, so we've talked about salary and dividends. Now we need to talk about loans. Now, I don't hear many people talk about this, but a very convenient way to take money out of your corporation is to take a loan. Now, as the director of your corporation, you have the ability to issue yourself a loan personally. So I can say, Tech with Tim Inc., which is my corporation, is issuing Tim Rosica, which is me, a $10,000 loan. Now, there's all kinds of rules on these loans. First of all, I don't have any interest on the loan. I can do a zero interest loan. However, I'm only allowed to carry a loan on the books of my company to a director or shareholder of the company for 2 years. Now, this is pretty obvious. If you didn't have this, then you could just infinitely loan money, and then personally, I can never pay that money back. And of course, that would just be fraud, right? So that's why they have this rule. You can only carry the loan for 2 years. Now, with this though, that allows me to reduce the amount of tax I would have to pay to access large sums of money. So for example, recently I bought a house. When I bought this house, I needed a fair amount of money for a down payment. I think I need an extra 15 grand. So rather than me bonusing myself 30 grand, which is how much I would have to bonus to have $15,000 after tax, because I live in Canada and the tax rate is absolutely insane, then what I would do instead, or what I did instead, is I loaned myself $15,000. Now, when I loan myself $15,000, what this allows me to do is access the 15K immediately and then pay it back to the company over 2 years. Now, since it's 2 years, this means I now have 2 years where I can keep my personal income relatively low and slowly pay back the loan at, say, $1,000 a month, $750 a month, whatever the amount actually may be. Now, what I can also do is I can write off my loan amount that I owe the company with how much the company owes me. So in a lot of situations, like now, I have an office, right? This office is in my house. My corporation pays me rent every single month to have the office in this house. It pays part of the electricity bill because of all the computers and lights and all the stuff going on here. It pays part of my gas for any travel expenses, etc. So at the end of each year, my corporation ends up owing me a few $1,000s. So now I offset the loan amount. So say I owe the corp 10 grand. Then if the corp owes me 7 grand, now I only owe the corporation $3,000. Then if I need to clear the loan balance, I can dividend myself the amount and clear the loan, or I can just wait till the next year and pay it off slowly. So hopefully this is making a little bit of sense, but the basic idea is that when you need a large sum of money, what you can do is loan yourself it rather than paying it yourself as a bonus or as a part of your salary. And then that way you can reduce the amount of tax you pay immediately and just pay back the loan over time. Now, you may still be short on how much you have to pay back. If that's the case, then you issue a dividend at the end of the year to clear the loan balance, and then you do have to pay tax on whatever that dividend amount was. All right, so I think that's pretty much it for accessing corporate funds personally. Again, the summary is you have a salary, you have dividends, and you have loans. And those are really the 3 ways you access your corporate funds in a personal manner. The whole idea here is to use these in a combination strategically such that you reduce the amount of tax you have to pay on money you pay yourself in a form of a salary or even as dividends, because that is the most amount of tax you ever have to pay when you get salaried income. So this is especially important when your income starts getting quite large. What you want to do is reduce the amount that you're paying yourself personally to reduce the amount of personal tax. You want to keep some of that money in your corporation, invest in your corporation rather than investing personally, and use a strategy I'm about to talk to you about called dripping out. All right, so now we're going to move on to deferring taxes and controlling income. Now, this is the main benefit of holding a corporation, especially if you own it just as an individual. Now, most of us understand at this point, when you get paid a salary, you pay the highest amount of tax you pay on essentially any kind of income. Your active income, which is your salary income, is taxed the highest. In Canada, if you make $250,000 or more a year, you are taxed at 53.5% on every single dollar above $250,000. So if I were to pay myself $500,000, effectively, I would be left with about $250,000. That's about what the math works out to. It might be slightly more than that, about $265,000. Regardless, think about that. You make $500,000 a year, but you only keep $260,000 or $265,000 or $270,000, even if it's $300,000. Still, that's a ridiculous amount of tax to be paying to the government. So with a corporation, the benefit here is that you can control this. If you make $1 million a year in your corporation, you don't have to pay yourself $1 million. You can pay yourself $100,000, $150,000. You can pay yourself the minimum you need to survive, and then you essentially pay the least amount of taxes you possibly can to the Canadian government in a personal way. Now, in the US, exact same thing. Now, I know taxes are lower in the US. It depends on what state you live in. There's all kinds of different strategies based on your LLC and what you're doing there, but the concept is the same. You don't want to pay yourself an absurd amount of money out of the corporation, because then you just get absolutely rinsed on taxes. Now, the question comes, okay, that's great, I understand that, Tim, but how do I get my money and use it from the corporation? Well, this is where kind of the process of dripping it out comes. So for me, I know that I'm not going to spend $500,000 a year. I'm not going to spend a massive amount. I don't want to go buy like crazy things that cost hundreds of thousands of dollars. So rather than me taking this money now and giving it to myself personally and forfeiting $200,000, $250,000, I'm going to defer my tax over a very long period of time and pay small amounts of tax every single year on the money that I pay myself. Now, what this allows me to do is amass a large sum of money that's already been taxed at a corporate level in my corporation. I have way more money in my corporation than I would if I were to pay it out personally. So I can now invest this money in my corporation and make outsized returns on this larger sum of money than if I were to pay it to myself personally and simply invest it in my personal account. So again, what I'm doing is I'm saying I'm going to pay myself the minimum I possibly can to survive. What I need for groceries, what I need for rent, what I need for a vacation, whatever money I want to spend, that's what I pay myself personally. I essentially spend all of it. I save a little bit, so I have a bit of a personal cushion, but essentially I have unlimited access to funds from my company. So why do I need to pay it to myself when I don't need the money? I don't. So instead, I pay myself whatever I require. I pay the taxes on that, and then I keep the rest of my money sitting in my corporation. Now, yes, it does get taxed in my corporation, but in Canada, the corporate tax rate in the province I live in is 11%. So that means that I now keep hundreds of thousands of dollars more per year than if I were to dump it out and just pay it to myself personally. I take all that money, I invest it, and now my money that's invested can make so much more money that later down the line, I don't mind paying myself a little bit more and paying some more tax because all of this invested funds is generating essentially full-time salaries, right? Massive amounts of income per year because I have a way larger amount than if I were to give it to myself personally. So hopefully you guys are understanding the process here. You want to amass the large amount of capital in a company where it's taxed at a very minimal amount. In the US, I think it's like 22%, 25%, right? For me, I have small business tax rate currently. Soon I'm going to be out of the small business tax rate and having to pay more. But for me, it's only 11%. So I take all this massive amount of money, I keep it in my company, I invest it in the company, and it grows, and then I slowly drip my money out every single year and defer all of my taxes over a long period of time. Now, once you get to the point where you have millions upon millions of dollars, okay, you can start taking out more. And yeah, you're going to pay a high amount of tax, but at that point, your investments have grown so massively because of the strategy you used earlier, now you don't mind paying the extra amount of tax. Whereas again, if I were to pay the tax earlier, that reduces the amount that I can invest and reduces the amount I can make on my investments and can compound over time. Hopefully that makes sense, but that's the strategy here. That's what you want to consider, and that's how you need to kind of think about this whole strategy using the corporation. All right, so now we move on to talking about some details related to investing in a company or a corporation. First of all, you can obviously do this. Any massive company you know has investments or has holding companies that hold investments for them, okay? So you can invest in a company. Most very wealthy people you know have a lot of their assets in different corporations for this purpose, right? For investing. Now, one thing you want to know about investing in a company is you have a realized gain versus an unrealized gain. Now, this applies personally as well, but the idea is your realized gain is a gain that you have made by selling the investment. An unrealized gain is a gain that you've made, but you've not yet sold. You haven't essentially locked that gain in. So very simple example, I invest $50. It goes to $100. I don't sell the investment. I have an unrealized gain of $50. Okay, realized example, I have $50, becomes 100. I sell it. I have a realized gain of $50. My investment went up by $50. Now, this gain gets taxed. You only get taxed on the gain when it is realized. Now, this is another way to defer taxes. You never realize a gain, or you take a very long time, or you realize it over time, right? Anyways, I realized my gain of $50. As soon as this becomes realized, now I pay capital gains tax. Now, capital gains tax is 50% of the capital gain is taxed at whatever the capital gains tax rate is. I know this seems a little bit confusing, but if I made $50, right, that's my realized gain, only half of that, so $25, is taxed, and that's taxed at a different rate depending on a lot of other factors, state, province, etc., right? So in my case, it's taxed at about 50%, and that means that effectively I get taxed 25% on the total gain. So if I made $50, I get taxed 25%. I pay $12.50 in capital gains tax. There you go. Okay, that's how capital gains tax works. Now, next thing you need to understand is that once you have all this money, right, and it's invested, you want to start thinking about reducing your liability. So the issue happens, or the issue occurs, when you start obtaining a lot of investments or a lot of cash within an operational company. So for example, I have Tech with Tim Inc. I do sponsorships, I have all kinds of clients, I sell courses, and there is some inherent liability in what I'm doing. It's possible I could get sued for something. Now, if I were to be investing all of my assets in my main operational company and I got sued, those assets are up for grabs. So what you need to start considering once you get larger sums of money is, how do I protect these assets from the liability of my corporation? Now you're reducing liability at a corporate level, not at a personal level. So we've already reduced the personal liability by separating our operations into a company. Now we need to separate our assets into a holding company to reduce liability from the operations of the main company. Okay, so hopefully this is making a bit of sense. So what you want to do is you want to set up now a separate corporate entity, and there's all kinds of complex structures to do this. I'm not going to walk you through the exact process, but you need to set up a separate company with legal advice that will allow you to transfer assets from your main corporation into this company. Now, typically what ends up happening is your holding company is going to own the operational company, or it's going to be the beneficiary of something like a trust, and the trust is going to own the operational company. Now, this allows you to essentially take the profits from your operational company and transfer them to the holding company, where then in the holding company they get invested. Now, in this holding company, you have zero operations. The whole purpose of the holding company is to hold the assets of one or potentially multiple operational companies. So now you invest in the holding company and you reduce that liability. So now if your operational company gets sued, they can only come after the assets that the operational company owns, not the holding company, because the holding company is on top owning the operational company. Now, it's very important that when you do this, you don't taint the way that assets are transferred. If you transfer assets in a non kind of legal way or in a certain way, you can essentially taint the relationship between your operational company and your holding company, and you can open up liability in your holding company. So again, this is something you need to talk to a lawyer about. I'm not quite qualified to get into that much detail, but just understand that the way you transfer is important, and you need to discuss this with professionals that have set up these structures before. All right. So with that said, that's pretty much gonna wrap up this video. There was quite a bit of stuff here. I apologize, it was kind of all over the place, but I really just wanted to sit down and kind of just rant to you guys about all this business knowledge, because I feel like I've obtained quite a bit. I've learned so much over the past few years, and this is stuff that took me a really long time to learn, was really expensive, and that I think should be free, and that all of you should know and understand. If I had been taught this when I was 17, 18, I can only imagine where I would be right now, and I hope that this opened up your kind of horizons and perspective on what's possible with corporate structures and why you should consider getting into them as your income grows. Full disclosure here, I make hundreds of thousands of dollars per year. This is not something that makes sense to do unless you make a lot of money. If you don't make a lot of money, you're going to pay a lot in fees. My lawyer, accounting, bookkeeping fees per year between my corporations is probably around $20,000, right? In terms of all the stuff that I need to do, setting up new entities. It's expensive, but in the long run, it saves you a ton of money, especially in tax. So with that said, I'll wrap it up here. Hope you found this helpful, and I look forward to seeing you in another YouTube video.